Hello, everyone. I hope you're having an amazing day. This is the third part of a video lecture on portfolio optimization. So if you haven't seen my other video, I would definitely recommend checking that out. You can see that on my channel. This one goes into a two-asset portfolio. Today, we're going to build on that by going into more assets. But just as a reference, if anyone's looking for the code in any of these videos, check the descriptions. As you can see, I've included the link to the RStudio and as well as the Markdown file and the Excalidraw file as well that I'll be going over. And also check for the timestamps if you feel you need to skip a certain section. I've included timestamps in the videos, so definitely feel free to check that out. Yeah, so we're going to start by going over just briefly some of the theory. It won't take as long as the two-asset portfolio one, but I do want to just touch on some of the basics behind this because I think it does get a little bit more complex. And then we're going to go into the code. So this should help you for 506 students. This should help you with the first half of your project, I would say. I've decided I am going to split this video into two with regards to your project. So the first part will be doing the optimal weights, the global minimum variance, efficient frontier, and the index portfolio. And then in the next video, I'm going to go over how to do the regression, the CAPM regression, as well as the VAR and a couple other parts of that. So whatever isn't touched on in this video with regards to the project will be touched on in the next one. So without further ado, I'll go ahead and dive into the drawing portion of this. So let's just start out by talking about what is our goal when we go into portfolio optimization. So our goal is to minimize a certain variance of returns subject to a certain return threshold. So we need to get above a certain return amount while we're minimizing the variance. You could also state this the other way, right? As maximizing the return subject to the variance has to be below a certain amount. So just as a review, what do we talk about when we mean variance or volatility, right? Volatility, we usually measure in standard deviations. This would be the square root of the variance. So when we're talking about variance of returns, right? When we invest in a certain stock every month, our portfolio is going to change. That's a return. And we want to minimize how much that portfolio changes. That's the volatility. So as you can see, this is an individual asset, AMD. The returns are going to range from negative 0.3 to 0.4. So this means, from on an average monthly basis, we don't know. Our returns could range from negative 30% to 40%, right? That's quite a swing in the portfolio. And a lot of times, investors don't want to be sitting through those periods of time where you're going through 30% downturn in your portfolio. That can often be, unappealing, undesirable. You don't want to have to sit through all that anxiety. So you might try to, the goal is to minimize the risk, right? The volatility is a measure of risk. So we're minimizing risk subject to, we have to get a minimum return. And yeah, so, referencing the individual asset versus a diversified market portfolio. The diversified market portfolio, these returns range from negative 0.1 to 0.1, right? So negative 10% to 10%. That's really the range of returns if we invest in a broad market portfolio. So this one, you're going to be seeing a lot less change in your wealth, change in your portfolio. And that's really what we're trying to accomplish. The reason that this is so low, right, is because it's diversified. So that's one of Markowitz's big contributions was talking about the effect of diversification on minimizing risk. We can actually see it in practice here. So that was just a visual demonstration of variance or volatility in returns. Okay, so the model that we're following, right? So we're minimizing, let's say we're going with this one, right? We're minimizing the variance of the portfolio. And this variance, the portfolio, Markowitz is basically, has given us this definition. where this is coming from is when you write out the component form of the variance of returns. I'm not going to go too much into that. If you're curious, you can look at the Wikipedia page for portfolio optimization, or check out another video on that. But when you simplify the component form, you put it in matrices, it looks like this. So basically, the variance of the portfolio returns, that would be the vector of portfolio weights that we have. So the weights of the certain assets in a vertical column being multiplied, sorry, in a horizontal column. And this is the transpose of that, right? So that's why it's horizontal, because it's being transposed. Normally, this would be a column vector. And that's being multiplied by the variance covariance matrix, right? The covariance matrix of returns. And what's nice about the covariance matrix is that it's symmetric. So we'll go into some of the benefits of that, but it basically means that when you flip the columns and the rows, the values are exactly the same. So we went over that covariance matrix in the other video. If you want a review on that, go ahead and check that out. Yeah, so the transpose of the weights multiplied by the covariance matrix multiplied by the vector of weights. This would give you the variance of portfolio returns. And then our condition is that we have to achieve a certain return, right? So the return we would calculate as the transpose of the weights vector multiplied by a vector of expected returns for each asset. So this would be the average of the returns. And that has to be above the risk-free rate, right? So this could also be the investor preference, but typically what we use is the risk-free rate. So the benchmark we're using, right, is, if you could have gotten better returns by investing in something like a diversified portfolio of bonds or 10-year bonds, then why would you subject yourself to any risk if the bonds are going to be, basically zero volatility of returns? So we're saying, okay, we have to get above a certain return, the risk-free rate. And that would be our condition. So now, as we're familiar, we have to convert this to Lagrangian form to enforce the condition. So this is the first part of that, right? That we talked about, the variance of the portfolio. This is the objective. And then we have the Lagrangian part of that. So you're going to add a Lagrangian multiplier multiplied by the risk premium. Like this is, and then you're going to add a Lagrangian multiplier. This is the constraint we're enforcing. So where do we get this? So as you can remember, this is our constraint, right? We have to get portfolio returns above the risk-free rate. So the goal of Lagrangian optimization is to penalize the objective, the variance. We're going to penalize that. And if we're minimizing it, we're going to penalize by adding to it, right? We're trying to find the smallest one. So if it fails the constraint, we're basically going to add to the variance to make it undesirable as like a final option. So if you can remember, right, we have the graph of the capital allocation line. So this is a bad drawing, I apologize. We have standard deviation and returns. We'll get into this later, but we have our various assets in the efficient frontier, right? And the capital allocation line, tangency portfolio. And basically the global minimum variance would be over here, right? Somewhere on the very left. But the point is, if we're trying to find the optimal portfolio, the tangency point, what we're going to do is, if there is a stock that doesn't satisfy this constraint over here, we're basically going to add to its variance, which will affect the standard deviation, right? The square root of the variance. So that's going to add to that, which will make it an undesirable portfolio option. This was sort of badly drawn, but you can imagine it looks like that, right? Where it's like just just on the tip there. And if this was the tangency portfolio, if we add to the variance, well, it might end up somewhere around there, right? At the same level of risk or at the same level of return, we might be getting higher standard deviation. So we have a higher risk, right? Because it failed the return constraint. So the way that we're doing that, right? If we convert this equation, if we make this equal to zero, what we're going to end up with is the risk-free rate minus the return of the portfolio. And it has to be the risk-free rate minus this, because when the return of the portfolio is greater than the risk-free rate, then our constraint is enforced, right? That's what we want. We want the return to be higher. So then we're going to lower the variance, right? This would be negative. But when the return is less than the risk-free rate, then we've failed the constraint. So we're gonna penalize the objective, which is increasing the variance, right? When this is greater than this, or when this is less than this, then this whole thing over here will be positive, which will increase, which will be multiplied by the Lagrangian multiplier and increase the objective. So that's just how we get that. So the next step will be differentiating with respect to W, right? And this isn't entirely necessary to know how this is done. This is more for me. I like to see how the derivation is done. So if you want, you can skip this part, but this is how we're kind of arriving at how we solve it. But I'll go into how we solve it next. So yeah, we start with differentiating this Lagrangian function with respect to the vector of portfolio weights. So what's nice, remember we talked about the covariance matrix is symmetric. So when we differentiate it, basically the transpose of a vector, right, multiplied by a covariance multiplied by a vector, that's going to end up, when we differentiate it, this is just a rule of differentiating a quadratic form, we're going to end up with this, which is the covariance matrix and multiplied by the vector of portfolio weights plus the transpose of the covariance matrix multiplied by the vector of portfolio weights. And since it's symmetric, since these are equal, right, the sigma and the sigma transpose, we can just add those. So we end up with 2 sigma W. So 2 times the covariance matrix. And lambda and RF are constants. RF we're going to reintroduce into the constraint pool. We'll talk about that. But the Lagrangian multiplier, for now, we're going to treat them as constants. So when we take the partial derivative of just this part, just the right part of this equation. So first we did just the left. Now we're going to go into the right, which is this part. So the derivative of that, the negative lambda, that's going to be a constant, right? So we pull that out, and we're going to just take the derivative of transpose weights, the portfolio return part. And when we do that, right, the transpose of W, another rule, since this is just the dot vector, the derivative will be the constant of R. So, I mean, this is the vector of portfolio returns, but these will be constant values. So we will get negative lambda R for our final derivative of just this portion. And when we combine the terms, it's 2 sigma W minus lambda R. When we solve for W in this equation, we essentially end up with lambda over 2 sigma negative 1 times R. And professor uses a Z approximation for this by reintroducing that risk premium with the minus RF. Um, and this is what we're going to use today. But I just wanted to show you like where that approximation comes from. So this lambda over 2 is a scaling constant. You can go ahead and, for visual purposes, that's not included, but this would be technically more appropriate is the lambda over 2. But since this is essentially like this won't change the weights when we calculate them in the final weights, so we can drop that for the purposes of the weights. And but this is where we get the inverse of the covariance matrix multiplied by in this case the risk premium. So we define Z as the risk adjusted measure of return, right? And then adjusted by the covariance matrix. So basically this equation will get us the unscaled portfolio weights. We're familiar with that, but this is what we're going to use to solve. So this would be important to remember. The Z, the unscaled portfolio weights, is the inverse of the covariance matrix multiplied by the risk premium matrix, which is the difference of the expected return matrix and the risk-free matrix, or the risk-free rate. So, and then again, that's unscaled. So the last step would be solving for the normalized weights, right? Pretty simple. We're just dividing that whatever Z that we get by the sum of the Z values for each. So that would just be finding the normalized weights so that everything adds to 1. Okay. So the next part of this, we're going to go into the code. All right, so last time I made the video, there was a bit of an issue with the visibility of the code because it was in R, and you can only see like one kind of side of it. So this time I put it in a Notion file. This will also be in the description of the video. This should just make it easier to see the lines that I'm doing. So I'm not going to walk through writing each line. I will explain the lines as I'm going through. And hopefully that'll shorten the video a little bit and just make it easier to see and understand. So first of all, I just want to go through what this code does. And for that, I am going to use R. So basically, this code is an adaptation of the 5-asset portfolio. The specific code for the 5-asset will be in the specific code for the 5-asset will be in the GitHub folder as well. So that link will be in the description. Basically anything you're looking for, just check in the description. But yeah, so this is an adaptation of that basically works for any amount of stocks as long as it's within the date frame. So if you want to, download this file and try it out, you can. If it doesn't work, just realize that it might be because one of the assets you're choosing isn't within the date frame. So, I'll just show how this code works. Essentially, what we're doing is it's asking us what symbols we want to use. So we can use any symbols. For this, I'll just use AMD, Google, Microsoft, Tesla, and NVIDIA. And don't worry if you can't see the code super clearly right now. This is just for the outputs. So we'll use these for the 5-asset. You can use more. I'm just using this for demonstrative purposes. So basically when we use these, we run through a bunch of code and the output that we have. So we have a few outputs. The first is we're gonna go over how to do the efficient frontier, the capital allocation line, tangency portfolio. As we can see, the global minimum variance is the one on the very left, right? The one with the lowest standard deviation. And the other outputs, right? We have the data frame of the prices, the returns, and the excess returns. So the difference between the returns and the risk-free rate. We also have our various outputs. So the variance covariance matrix, mean and excess return, risk-free, optimal portfolio weights for various conditions, right? When we have short sales, so we're allowed to sell the stock short versus no short sales, global minimum variance, and statistics for the various portfolios compared to benchmark of S&P. So this works for any number of assets, but I do have the reference code for just specifically 5 for the purposes of your project. So yeah, so now we'll go over how to do that. But just for reference, this is the five asset one. So for 506 students for your project, if you want to use this as a reference for certain codes, that's totally fine. Just keep in mind we are going to be going through, making sure that it's not just copied over exactly. So now I'll go over the parts of this code. So the first section, right, the very beginning, we just have for an R markdown file, this is, usually the first 4 or 6 lines that is outputted when you make that file. Just make sure not to delete this because it's necessary for R markdown. This is known as the YAML header. You can edit this to add things like number of sections. So this would give you like headers if you use like a hashtag when you type the header. So before you type the header, you just put a hashtag, that'll make it a header. So yeah, you can edit this, just make sure you don't delete it. Yeah, this is used for rendering. So the first part is the setup, right? So we're going to install packages, import the data, and create data frames. So first of all, I like to use this if statement for installing packages. Just if we need it, install this package. The ones we're going to be using are QuantMod, CorpCore, Plotly, Forecast. The forecast isn't actually necessary for this one, but I just put it because the next video that will build on this code is going to use that. So that'll go into forecasting. It's like, the whole winter forecasting in various different types. So really the ones that are going to be important, QuantMod, CorpCore, Plotly, QuadProg, and ggplot too. Yeah, so just make sure you have those, and then we need to reference them with library. So this cat is basically just telling the program to say something. So this part is just asking for the symbols, and then that's what we're using. So the user input symbols are what we're using for the get symbols function later over here. So we set a start date and an end date, right? So it's going to use the user symbols, and you can always change this to just make it your own symbols if you wanted to. Instead, you could just set assets to be a string of, within quotations, your assets separated by commas, and then just use that for the symbols, and this would work the same. So yeah, we're going to use periodicity, and I apologize for, the code cuts out weird. There's nothing I can do about that. But you can still see it mostly. Yeah, so we're using monthly data for this, and we're going to just auto assign the data to the data frame. So that's just going to, just for organizational purposes, it'll just automatically assign the columns. So for 1E, this is basically, we're just organizing the price data and calculating the returns by applying, they'll apply a logarithmic transformation to the prices. So we're using the difference of logs for the returns. You just do difference log in the price, and that will calculate the returns. So this is, an easy way that we can do it for many different ones, but you could also just, delete all this and just use this part of the code if you're just doing it for a certain string of assets. So now we're using the get symbols for TNX, right? And we need to adjust it for monthly. So we're doing the same thing, but our TNX prices, we're just dividing by 1200. So this is going to be our risk-free rate, 10-year bond. And then this is how you would adjust it to monthly, divided by 12 months times 100. So we'll get the returns from that. And that will, that's how we do the return to the bond. It's just the same thing, except we're going to omit the first column for the lag adjustment. And then we're using that for the risk-free rates. And then when we calculate the average of that, we'll use that for the average risk-free rate. So here we're just calculating the excess returns by applying a function that subtracts the returns, subtracts the risk-free rate from the returns. And finally, we're combining the data into the data frames with the column labeled price and returns and excess returns. So I also included descriptions of this code if you guys want to go back and review this. Okay, so the second part, now we need to create the matrices, right? To be able to solve the problem. So we're going to calculate the covariance matrix by taking the covariance of the returns table. And then we're going to apply the column names and row names, right, as the symbols that were inputted. Now we're just going to make sure that everything is, being treated as a matrix for algebraic purposes. So, when we're multiplying these together, we want them to be treated as matrices. Now we're computing the means for each assets and their average returns, as well as the average excess returns over the risk-free rate. And we're organizing the returns and excess returns into a single display matrix. So we can give like a consolidated view of the excess returns just for display purposes. In the third section, we're calculating the weights. So this is where we get into the actual meat of the problem, right? And like we talked about here, the way we're going to solve that is with this Z approximation. So the inverse of the variance covariance matrix multiplied by the excess returns. So the difference in the returns and the risk-free rate. So we already have the excess return matrix and we already have the variance covariance. So we are going to use the solve function here. And this solve function essentially I included in the last video. It's solving AX equals B. So essentially we're solving for AX equals B, where B is the Z, right? The unscaled. X is the excess returns. Apologize for the handwriting. And A is the covariance matrix, right? So this is what the solve function is going to do. It will take the inverse of the A, right, and multiply it by that X value. And then that will solve for our unscaled portfolio weights. Then we have to normalize these, as we saw in the last step of this. Right, we're gonna just divide each Z value by the sum of the Z values, as we're doing here, Z optimal. And then just setting the dimension names, labeling them, right? Labeling this column as weights. That'll just be easier when we display it. Now, we also need to add another condition, right? Because initially when we went over this, and this is something that I didn't mention, but there's another constraint. in the Markowitz portfolio problem, right? That the sum of the weights has to be 1. You obviously have to have, a whole portfolio. So when you're dividing that, you want the weights to add to 1. And the reason that we're not enforcing that earlier in this setup of the optimization problem is because we're actually going to do that in the code itself. So we'll go over that in a little bit, but for now, just know that that's why we have to take these separate portfolios, right? But so for step 4C, this part of the code is going to create a diagonal matrix where we have the number of rows and columns equal the number of assets, which is the number of columns in DMAT, right? Our variance covariance matrix. Each diagonal entry corresponds to 1 asset and it's set to 1, right? And the off diagonal entries are set to 0. And then cbind is going to combine the two matrices, which is a column vector of 1, representing the constraint that the sum of the weights has to equal 1, and the diagonal matrix, which was created in the previous step. So the resulting matrix, AMAT, is going to have 1 row for the constraint on the sum of the weights equaling 1, and additional rows representing the individual constraint that each asset has to be non-negative, so greater than or equal to 0. Now we're creating the right-hand side vector. So this part will create a vector of zeros with a length equal to the number of assets, the number of columns in DMAT. And then this whole thing will combine the number 1, which is the total weight constraint, with the vector of zeros. So these are just ways that we can enforce that constraint. Now, in this step, the optimization problem is basically solved. We're using solve QP, which addresses the quadratic formulation, right? When we have the no selling constraint. So it'll take the covariance matrix DMAT, the vector of expected returns, DVEC, the constraint matrix AMAT, the right-hand side vector BVEC, and the parameter MEQ equals 1, which indicates that there is 1 equality constraint, the sum of the weights equal 1. So the result of the optimization, which includes the optimal weight under the no short selling condition, is stored in the W optimal NS, right? No short. So now we're just converting these weights to matrix, and setting the dimension names. And we're rounding the really, really small values to 0. These you would not realistically ever be able to invest shares in, so we're just making those 0. So for the global minimum variance portfolio, this one, essentially all we're doing is like we did in the other example, or I'm not sure if we did this in 2 asset. Basically, instead of multiplying the inverse of the variance covariance matrix by the excess return matrix, we're just going to multiply it by a matrix of 1s, because that's the only constraint that we're trying to enforce, is that the weights just have to add up to 1. We're not trying to get a certain return. We're just trying to find the global minimum variance, right? So the standard deviation the leftmost standard deviation on the efficient frontier, the smallest variance, smallest standard deviation, regardless of where the returns are. Now we're calculating the portfolio statistics, and these are various statistics that we're just using to measure. You guys can go ahead and just look here, pause the video if you'd like to see any of these formulas. Otherwise, you can just see this in the file below. I won't go into like all of these in detail, but essentially we're calculating the excess return, the weights times the return matrix. And this will be all the returns, right? Not just the average returns. So because this is going to get us the returns for the whole portfolio. And then we're doing the return variance, the standard deviation, Sharpe ratio, right? The difference between the returns and the risk-free rate divided by the standard deviation, the trainer ratio. We haven't really gone over this, but this would be the formula for the beta that we're going to use, because the trainer ratio is the return minus the risk-free rate divided by the beta. And so this would be the transpose of the optimal weights multiplied by the variance covariance matrix multiplied by the regular weights not transposed. So that's what we're going to use for the beta to get the trainer ratio, and the coefficient of variation, the CV, right? Which is just going to be the standard deviation divided by the return. And we're doing this for all of the portfolios, right? So the global minimum variance portfolio, the optimal portfolio, and the optimal portfolio with no short sales. So make sure we're doing that for all three of those. So lastly, we want to do the Sortino ratio, right? And the Sortino ratio is ultimately going to be the optimal return, or whichever one you're using, the optimal return with no short, or the global minimum variance return, minus the risk-free rate divided by the downside deviation. So for this one, we're going to use the semi-standard deviation. And so for that, we first want to set the return table as a matrix, because we're going to use the return table, not the return matrix. So we get the portfolio returns, the weighted portfolio returns for each of the asset returns for each month. And we're going to do that for all three portfolios. And now we calculate the downside deviation, right? So we are going to subtract the portfolio returns from the mean, subtract the mean portfolio returns from each of the portfolio returns, right? Do that for all of the portfolios. And now we're going to replace the values that are positive with 0, because we're only trying to figure out what the deviation is to the downside. This would be like, we want to see like how bad can it get, right? We don't really care about the ones that are positive because those are good for us. Like, we're not trying to take those into account. We only want to minimize the bad volatility, right? Like, this is like, when we look at this individual asset volatility of returns, this volatility would be good for us if we were buying this stock. So we might not want to take into account the positive volatility. We might only want to look at like the negative portions of these. So that's why we use the trainer ratio, or the Sortino ratio, sorry. Now, once we have these downside deviations, right, we're going to take the variance and take the square root of the variance to get the semi-standard deviation. And then we can use that to calculate Sortino ratios. So once we have that, we'll create these tables by just combining all of this information, right? We're going to make this a matrix, add all these columns, and label the column names. So now we're going to make sure we have a benchmark to the market portfolio. And this, we just follow a very similar process. just downloading the S&P data. We're going to use GSPC for this monthly. And we follow exactly the same steps to calculate the statistics. And we're just going to add these to the table by combining the statistics into their own table, right, for S&P 500, and then just combining all of the tables together with Columbine. So with that, we need to make sure we have all of the correct dimensions of the table. So I'm actually going to zoom in a little bit for this. So we're going to create a function, generate weights, to generate all possible weight combinations for the assets using a specific step size. And so this function is going to construct combinations of weights for the number of assets, where each weight can vary from negative 0.2 to 1. And this is sort of an arbitrary number. This is just, not taking more than a 20% short position. And so that number can be adjusted depending on investor preference, but we're just going to use negative 0.2 for now. And then only combinations that sum up to 1 are going to be included. So in 7C, we're just using the generate weights function to create the possible weight combinations for assets based on the previously defined number of assets, right? So we're going to store these in the fractions variable. And in 7D, we're just setting up empty numeric vectors return P SDP to store the expected return and standard deviation for each portfolio configuration. In 7E, for each weight combination in fractions, we're calculating the expected return as a weighted sum of the mean returns and standard deviation using the variance covariance matrix. 7F, so we're defining the capital allocation line, which represents portfolios that combine the risk-free asset with the optimal risky portfolio. We're generating a sequence F representing the standard deviation, which is the risk along this line, and calculating the expected return based on the optimal Sharpe ratio. Now we're plotting the efficient frontier by mapping standard deviation against portfolio returns. So these are all sort of just aesthetic settings. This is the legend, right? We want to label the points. We're overlaying the global minimum variance point, the standard deviation of the global minimum variance, the return of the global minimum variance, right? This is going to be that point. And we just label these. PCH is just a type. The optimal tangency portfolio, we label that, right? And we include a legend to separate them, include the colors. PCH, if you guys are curious, this just specifies the type of point. These are various options that you have, right? So we're just setting like what those points are going to be. If you want to pause the video or take a picture of this for reference, it's up to you. So this will get us our capital allocation line that we saw here, right? We have the global minimum variance point, tangency portfolio, capital allocation line, and all the portfolios. We could also map the individual assets on here based on their expected returns and standard deviations. That would be another neat visual tool. So this section is just going to print the data frames. This is all just, actually just displaying it. So we're definitely in the end game now. We're just, these cat ends are just separating it. So this just like, creates a new paragraph. Um, I don't know. It's just, I think it's just weird when they're laid on top of each other, but, yeah, so it's going to display all the different data frames, right? So these ones you could actually like look through, and then this will print the variance covariance matrix, mean and excess return, risk-free rate, and all the weights that we calculated for no short sale. So, and then this will print the combined statistics table. Now for the graphs, we're going to set the weights as a data frame and plot a bar chart with the labels. So this will just create a bar chart of the weights. I just like seeing it this way. I'm not sure if I put it that for reference at the bottom. Yeah, here. So this shows us like with these various portfolios, what the weights would be under various conditions. Okay, so here I enlarged the output. So I invested in 5 stocks, right? AMD, Google, Microsoft, Nvidia, Tesla. If we were allowing short sales, we would have negative weight for Google. So we would short Google and we would have over 100% in Microsoft, right? And partially in Nvidia. So this would be the optimal portfolio if we allow short sales. This would be the tangency portfolio, right? And then alternatively, if we don't allow short sales, as we can see here, it's basically all in NVIDIA, 93% of our portfolio, and just a little bit in Tesla. So this is what the bar chart part of that does. This will just set the color. And so that's why we're converting all these weights to data frames so we can plot those. Now, for the portfolio index, which would be the next part of that, this is going to allocate $100 to our portfolio, our optimal portfolio, and then compare it to $100 put into this S&P 500. So this is what the output of that would look like. We would have a graph like this. So this is what that output would look like, right? We have $100 invested in our portfolio versus $100 invested in the S&P. And we can kind of compare how these look, right? It looks like $100 to around 200 to S&P, a little under doubled versus our portfolio did pretty well. So the way that we can do that is through creating a date sequence, right? So we're just setting the same date sequence as we had initially and getting the S&P data, importing that, which we've already gone over. And now we need to calculate the returns of the portfolio for each period. So we're multiplying the returns by the optimal weights, creating a portfolio index starting as 100. So we're going to use the cumulative product here for 1 plus the portfolio returns times 100 to get the index, right? So we can just multiply that by 100. This is our dollars allocated, and that'll get the index. Now we're just creating this data frame of the date sequence and the portfolio index. And I just set the date sequence manually because I wasn't able to get it from the portfolio returns. But if you're able to plot it without the date sequence, then you don't have to use this. You can just plot the portfolio returns or the portfolio index. But yeah, so this is just setting the X and Y and also the second variable, the S&P 500 index. And now we're plotting it with plot, setting our X and Y axis labels and our titles and overlaying the lines and a legend. So this is the last part of the code. When we run it, right, as we saw back here, we get various weights, we get the index, and various returns. So you can see we get the excess returns, returns, price, and all the weights with the matrices. So this will give us a very nice summary of a portfolio. It's super useful if you're just trying to figure out, even just like on a retail level, like what stocks you should invest in and how you should figure out, how to minimize all those periods of time where you're going through heavy losses and things like that. So I want to end on this quote from Benjamin Graham. I know it's a little corny to end on a quote, but I'm going to do it anyways. In the short run, the market is a voting machine. In the long run, it's a weighing machine. So I think, part of the importance of this is that if you have a diversified portfolio, if you have a portfolio that's efficiently allocated, and you're able to minimize these returns, you don't have to go through as many periods of stressful waiting where you might be tempted to sell your portfolio, and succumb to this short term trying to time the market, because it's true in the short term the market is a voting machine and there are just so many factors that can affect it. But if you look at the long run, it's more heavily reliant on the fundamentals of companies and the fundamentals of things like diversification. And so I think this is a really powerful approach. You can use this code and this theory to optimize your portfolio, minimize your risk, and maximize returns. So with that, that has been the end of the video. The next one I'll go over is calculating the CAPM of the portfolio and the estimated beta of that, as well as testing whether the shutdown of the economy, COVID-19, had any effect on the Jensen Alpha market risk. We'll also go over the VAR and I think that's all, and the naive forecasting as well. So stay tuned for that video. But for now, thanks for listening and have a good week.